I first and foremost want to thank you all for joining me for preparing for a retirement webinar. My name is Cassandra Dorn. I've been in this industry for over 15 years and I love what I do. What do? I'm a financial consultant at Provident Financial Consultants. I do have one disclaimer. We are being recorded today, so I hope that's okay with you. If it's not, well, you can quick log off if you need to. Also, I get rather long-winded. I am going to try to get through all of these slides as best as I can. If you have any questions, you are muted. If you could send an email to info@providentfc.com, and there is the email on this screen for you. If we don't have time at the end of the presentation to answer your question, I will make sure somebody gets back to you with those answers. So again, any questions during the presentation, info@providentfc.com. One other item, if you did register, which I believe you all did for this webinar, we did send you some actionable items. We hope that the excitement that you get out of this webinar continues you moving forward and that you use these worksheets in what you learned today to prepare for your retirement or to continue planning for your retirement if you're there going forward. So let's jump ahead. I have a lot of ground to cover in 30 minutes. And if you're like me, noon hour, my tummy never forgets. So let's jump right into things. Over the course of my 15 plus years working in this industry, when I sit down and talk to clients, we often talk about retirement planning because that is a lot of people's goals. And through the course of these conversations, we talk about what brought them here. And a lot of times is procrastination. They meant to do it themselves. They found it very overwhelming or possibly depressing when they go to online calculators and punch in some basic information. Usually a rather large number pops up, and let's be honest, it can be scary. And so they just put it away and they'll deal with it another day. By attending today, I think you are crossing this one right off the list, getting out from procrastination and looking for new tools and ideas as to how to put together your retirement plan. The second one is understanding financial concepts. You know, it goes back to, we may think we're using the terminology correctly, but there's kind of two ways to use a word. And so sometimes there's misunderstanding. And again, that can be a little consuming. I know I'm that way when it comes to anything medical. People talk to me and a lot of times it's not a big deal, and in my head it becomes a big deal and a little overwhelming. So that can be a roadblock. And of course, failure to plan. Again, putting 1 and 2 together makes failure to plan sometimes an easy roadblock. You get overwhelmed, like I said, or you just coast along in your everyday business because life is busy and you just didn't sit down and put together a plan. And the last two, taxes and inflation. People forget about that. Just because you're retired doesn't mean the tax man doesn't come knocking on your door. We still have to pay property taxes and income taxes. And we also need to budget for inflation because unfortunately that tends not to go away either. So those are our 5 roadblocks. Now that we've discussed them, let's get that first one again crossed right off. Let's start planning. The first thing we need to do is we need to sit down and take inventory of our assets. So what do we have in cash? Emergency savings, CDs, large checking accounts if you have a lot of cash in checking. I also always encourage people to pull out their most recent financial statements from any retirement plans, IRAs, employer-sponsored plans, Roth IRAs, or after-tax investment accounts. With those statements, we can figure out what you have in stocks, bonds, and mutual funds and add those into our plan. Then we have your house. And while traditionally, I don't always include this as a retirement asset, it is always good to know what your home is valued at. And if you are planning on downsizing later in life and taking some of that cash out of your house to either fund your retirement goal or to possibly fund a retirement trip, it's good to know what the value of your home is today so we can use that for planning in the future. As far as the last 2 bullet items, cars, trucks, boats, furniture, antiques, jewelry, and coins. Again, these aren't always included as retirement assets, but it is helpful to write them down for current assets. If you have a coin collection that you plan on selling in the future, or a car or truck. Again, these are all things that could be pointed towards retirement, but need to be included in your plan today, because when we look at your assets, we also have to look at your liabilities on those assets. So again, when we look at the value of your home, we also need to look at the mortgage or what you owe on that home. The same can be said for car, boat loan, truck loans, any asset that you have a loan attached to. There's also credit card debt. Credit card debt is looked at a little bit differently. A lot of times the risk to credit card debt and those high interest rates are something that we like to plan to get rid of quickly if possible. So that grabs our attention when we're looking at planning for retirement now and in the future. There's also taxes due and any other major unpaid bills that are possibly in some type of payment plan like medical. So those are your liabilities. Take your time, go through those. And when you list them, list what the balance is, list what the payments are, and list what the interest rates are. These could provide great opportunities for future planning or current planning. A big one I touch on today is mortgage. If you have a mortgage, it's a great time to review that mortgage because interest rates are so low, and you may want to consider refinancing if it works for you. So now that we have our assets and our liabilities, let's put them together. So we take your assets and then we subtract whatever liabilities are owed, and that's your net worth. When people are first starting out, commonly net worth can be negative or very, very small. We have student debt, we have a large amount owed on our cars or our mortgages, and we're just getting started towards retirement savings. But the goal is, as you move towards retirement and through your lifetime working period, we see those assets increase and the liabilities decrease and that net worth grow. And that helps give us a little cushion in retirement. So now that we have our net worth figured out, let's go to your budget. Where is your money going? Now, this is always a fun discussion to have because a lot of people don't like going through their budget line item by line item. In fact, one person asked me, well, Cassandra, if you want a general spending plan for me, I'll just empty out all the receipts in my purse and I'll put together a little booklet for you and you can go through it and see how I'm spending my money. Which in turn seems like a great plan, but that's not where all of your money is going, right? We still have those utility bills that I don't think we get receipts for. We have property bills, we have mortgage bills, we have things that just don't get receipts and get shoved in our purse. But that's always helpful to see where that extra money goes. So why do we need a budget? Again, we need to look at where we're spending our money. Maybe if we are eating out a lot and we can't find out where is some of this money going? Well, we're going to restaurants that we're not planning for, or there's just certain line items that we're skipping over. So sitting down and really looking at where your money is going, reviewing any credit card bills, reviewing those receipts in your purse, those are all helpful items to identify where your money is going. And again, it helps lay out a roadmap as to where you're going to spend your money in the future. So let's break down that budget. This category, or this slide's a little different than how I like to explain it. They have fixed versus variable. I like to call it needs versus wants, right? So for example, when we move on to the fixed category of your budget, these are things that we usually always have to pay. Again, taxes, going back to that first roadblock, we cannot forget about taxes because taxes don't forget about us. We owe property taxes, we owe income taxes, we may own investment or capital gains taxes. So these are things that are usually always coming due and they're always in our life. Another fixed expense current could be mortgage. Now this could go away in the future towards retirement. But right now, for most of us, while we work, mortgage is a fixed expense. We also have utilities and insurance and car payments. Other fixed expenses could be groceries, right? We have to eat. Healthcare bills, things like that are all considered fixed expenses. On the next slide, we go towards variable expenses, things that can change from month to month. Now, when I refer to retirement planning, I say these are our wants. These are our fun items. These are items that could be adjusted if needed. Now, obviously food, like Cassandra, we always need to eat. Yes, I absolutely agree. I like to eat as much as the next person. But sometimes when things are tight or we have an unexpected expense that creeps into our budget, instead of going out to a restaurant, we may need to stay at home a little bit more. This is also a great time when you're budgeting, if you do have a significant other, partner, or spouse, to sit down and go through what they consider to be fixed versus what they or needs versus what they consider wants. So my husband and I, we're a little bit different. Clothing for him is a need. Clothing for me is a need. Clothing for him is a want, right? He thinks I have more than I need for clothing. However, I like to stay up on the latest trends. I like to have clothes. So we have to always push and pull a little bit as to what is a want versus what is a need, and then come together and budget on that. Okay, so now we have our expenses all lined up. Now we need to know how we pay for those expenses. So let's go through categories of income. If you are currently working, your wage or your salary is most likely the major source of your income. You could also have self-employment income or income from a hobby that you do on the side, such as photography, or maybe you like to fix up cars or do home appraisals in your free time. Although home appraisals are probably very busy right now. Then in retirement, you may expand this, you may not. In retirement, you most likely will have a pension or IRA distributions. There could be interest or dividends from any other investments such as CDs or money markets. And then of course, we have Social Security. And that for most of us will be one of the sources of income during retirement. So here's our moment of truth. This can be depressing, this can be exciting. Do our sources of income, is it greater than our expenses? If that's a no, we need to look at those expenses and maybe reclassify things as needs and wants, or look to reduce some of where our money is, or some portions of where our money is going. Or if we're full of energy or really advantageous, maybe we increase our income, right? Maybe we get a side job, maybe we expand that hobby into something that earns a little bit more money. But in the end, the income less the expenses on average should be positive. Now, if this is a big positive number, this could create opportunity for discussion as to where could we save that to further our retirement or to tax plan. So again, this is a very important slide to take consideration what that bottom number results in. Now let's move forward towards retirement, okay? We talked a lot about preparing and putting that road plan or path together to get there. Let's look at those income sources during retirement. Now, for a majority of us, like I said, we will receive Social Security. To give you a better estimate as to what you will receive, let's do a breakdown on how Social Security is calculated. So to qualify for Social Security on your own record, you need to have worked at least 10 years, approximately. You have to have 40 quarters of earnings. Now, how they calculate your actual benefit is based on your largest 30 years of employment. So let's say you work 10 years and then you don't work anymore. What they will do is put zeros in for those remaining 20 years and then give you an average. So these are all important considerations to look at when you're trying to estimate Social Security and how important of a role it will play for you in the future. A great resource for Social Security calculators and estimates would be ssa.gov. Okay, again, that's ssa.gov. You can create an account, you can review your earnings history to make sure it's correct, and you can project out your estimates for the future. The next thing I want to point out on this slide is I feel it's a little outdated. We can see that private pensions and government employee pensions are a pretty nice chunk of the pie. I will tell you, the longer I stay in this industry, the less I see pensions come in as a part of the income during retirement. My husband actually has a pension from his employer. It was frozen over 10 years ago. I think in our projection, currently, it's about $50 a month. So by the time we reach retirement spending age, it's not going to mean a lot with inflation and taxes. It's not something I forget about, but it's not something I count on. Also, I'd like to point out earnings is what some people plan on in retirement as part of their income needs and income planning. That's great if you have a hobby and you now have time for it, or if you just really are passionate about what you do and you don't see yourself retiring. you can plan that forward. I will tell you myself, I work really hard right now. I would like to take some time off and travel. And so right now, earnings isn't in my retirement future. But as I continue to do my checkup on my plan, if that changes and I need to work, well, then I need to work. But right now, in my planning, I don't want to plan on it. So I'm trying not to, which then leads us to asset income. Asset income is income from IRAs, employer-sponsored plans, or any other investments. When we sit down and plan for people, we always talk about employer-sponsored plans or retirement contributions in general. So let's talk about those a little bit more in detail. When it comes to retirement options through your employer, you could be offered several types of plan. You could have a traditional pension, which a lot of people will say, yes, my employer offers a pension. And to me, a pension is an income stream like Social Security. However, for a lot of people, when they say pension, they mean 401ks or 403bs or ESOPs. One second. Heather, can you flip, please? Thank you. Sorry, technical difficulty. So let's talk about 401ks and contribution levels. So again, some of the misconceptions are when I sit down with people and we talk about their employer-sponsored plans, a 401k plan is the most commonly used type of plan that their employer offers. When I ask clients, how much are you putting into your 401k? They'll tell me, I'm maxing out. Now, in my mind, maxing out means if you are under age 50, you are putting in $19,500 a year. And if you are over age 50, you're putting in $26,000 a year. So for an average client who's earning $50,000 a year, that's a lot of money. What they usually mean is they are putting in the maximum amount they need to get the full employer match. Again, for example, a common match is 3%. So if someone is making $50,000 and they're putting in the full amount to get the match of 3%, they're putting in $1,500 a year, not $19,500. So this is, again, why we ask for statements from time to time, just to clarify everything and make sure everyone is on the same page, because we are trying to reach a goal together and work together. So we need understanding as to where the contributions and retirement savings are going and to what amount they are. Now, as we move forward into retirement, a lot of people ask me, how much do I need to save? And I usually give them a percentage based on where they are in their working life and say, you know, if you can, try and increase that every year by 1% if possible, because we need to save more and more, because as we get closer to retirement or in retirement, we can't forget about inflation. The cost of our current lifestyle usually goes up a little bit every year. And to give myself a little bit of dating, and I feel bad about this, but when I first got my license, to get a gallon of gas was well under 90 cents. Until about March of last year, I never thought I'd see numbers that low. Now, COVID brought them down to about 95 cents, I think, but never under 90 from what I found. Driving around this last weekend, the average gallon of gas was anywhere from $2.27 to $2.10 a gallon. So again, that is what we need to take into account. You're still going to drive your car in retirement. We need to make sure that you can fill up that gas tank. Now, on a side note, you know, everyone gives me a hard time in the office. I love McDonald's cheeseburgers. You used to be able to go to McDonald's and get a cheeseburger off the dollar menu. You can't even do that anymore. So make sure, again, that you're accounting for inflation when you are planning to retire. So this is all overwhelming. We're going over a lot of stuff, things that take a lot of time, looking at your budget, looking at where your money is going. What if you say, Cassandra, give me a very quick synopsis. If I'm going to do the bare minimum today, and I'm not going to procrastinate, just tell me, how much do I need in retirement? Well, that's a really hard question to answer, but in general, what I will say is, if you need a starting point, something to just get you going and get that first line item crossed off your list, is look at your current income today and plan for about 80 to 75% of it, okay? So why do I say a little less than what you're earning now? Well, one, you won't be saving for retirement anymore. You'll be in retirement. And usually for most of us, we do take a little off the top and set it aside for the future. You may also be participating in a health savings account. Once you reach age 65, if you go on Medicare, you can no longer put into a health savings account. So again, that's an added savings you won't be doing anymore. You also may have Social Security tax and Medicare tax. Now, I didn't say income. You'll usually always have income tax, but Social Security and Medicare tax may go down, and on average, your tax situation may decrease. I will tell you, I try and keep your current spending as close to your future spending as possible, because if you're like me, I just want things to shift. Meaning, I love my children, but they like to eat, and I have to pay for that, and I have to pay for braces, and I have to pay for sports, and I have to pay for all of that, and it costs a lot of money. I hope that in the future, I'm no longer paying for them, that they're out of my house, that they're on their own and living in their own homes. And what am I going to do with all that savings? I'm going to just shift it. I'm going to shift it to travel. I would like to travel. I don't travel right now because I have these children to feed. I would like to travel to their house. I would like to leave their doors open in the winter and heat their outside yards. Okay, so this is kind of where I'm thinking I want my life to go. We also talk about mortgages, and I referenced earlier in the webinar that you have a mortgage now and you may not have it in the future. Again, that mortgage, those payments may just shift to being a snowbird and renting somewhere for the winter months, or going on extra trips. It's all about where are you spending now, and if some of those items come off your expenses just because they're going to phase out, do you want to spend them in a different area in the future? So down and dirty, nitty gritty, this is where I would start if you don't want to go through budget and line item by line item and spend a lot of time on it. This will get you your first step to get excited towards retirement. Now, one item, unfortunately, I did not cross off and you did not hear me say is medical expenses. Unfortunately, medical expenses is something that will not go away in the future. On average, a 65-year-old American couple retiring in 2020 will need about $295,000 to pay for medical expenses throughout the retirement. And this does not include long-term nursing home care. So where does this money go? Well, you still have premium payments. You still have drug costs. We plan for our clients to be in retirement for 30 plus years. So that's a lot of years of medical expenses. One gripe I always hear about are hearing aids. Hearing aids are a costly ticket item in retirement, and I guarantee that you only jump in that ocean or that pool one time with those brand new hearing aids on, because you don't pay that ticket item more than twice. So these are things that you do need to plan for and take into consideration. Now, I referenced on this slide, it does not include nursing home care. Nursing home care is something else that you may need to consider. A great resource for nursing home care or long-term care needs is www.longtermcare.gov. I would tell you to go there, spend some time there, look at the average cost in the area that you wish to retire, right? The cost of a nursing home stay in Wisconsin is different than one in Arizona. So again, this website will have some of that information. It will tell you that on average, the stay in a nursing home for a person is about 835 days, which is about 2.3 years. It will tell you all of those statistics. And what I would tell you is sit down and read through those and figure out what you have at risk, what should you plan for, and just really have an open conversation with yourself and anyone else who could be affected by you needing that care. Now, with all that being said, I have about 5 minutes left for any questions. So Heather is going to go through and see if there's any questions. And while she does this, because this is recorded, because we are talking about retirement and financials, I need to read a quick disclaimer to you all. So here we go. This presentation was created for educational and informational purposes only and is not intended as ERISA, tax, legal, or investment advice. If you are seeking investment advice specific to your needs, such advice services must be obtained on your own, separate from this educational presentation. With that, there are no questions. So with that, I just want to thank you for joining me today. I hope that you received a few pieces of information from this webinar that you can take with you. Don't forget about those worksheets. They are great tools for you to use when putting together your financial plan or doing an annual checkup on your financial plan and goals.